The day finance stopped being about gold, there was a moment when money stopped being something you could hold. It became something you could promise. And the world has been chasing that promise ever since. To understand the day finance stopped being about gold, we have to return to a time when wealth felt solid. Gold was not just valuable, it was reassuring. It was heavy. It was physical proof that a nation could pay its debts and defend its currency. For centuries, gold acted like the final authority, a silent judge that forced governments, merchants, and banks to stay honest. But honesty has limits when the world grows too fast. Trade expanded, population surged, wars became expensive, and the modern economy began demanding more money than gold could realistically support. Not because gold disappeared, but because the world's ambition outgrew it. The old system began to feel like a locked door in front of a growing crowd. And London was one of the places where that pressure was felt most sharply. Because London wasn't just handling local commerce. It was processing global trade. It was financing shipping routes, underwriting risk, lending to businesses, and feeding the appetite of an empire that never stopped moving. Gold was still the foundation, but the foundation was starting to crack under the weight of modern demand. The first beat of this story begins with a simple problem. Gold moves slowly. It has to be mined, transported, guarded, and stored. In a world that was beginning to think in days instead of months, gold felt like friction. It made the economy cautious when the world wanted speed. So finance began looking for shortcuts. Then the second beat arrives. Paper starts to matter more than metal. Banks issued notes. Merchants accepted them. Governments used them. And slowly, a new idea took hold. If people trusted the paper, they didn't need to see the gold every time. Trust became the real currency, and gold became a symbol rather than a daily tool. The third beat is where the transformation becomes irreversible. Credit expands, not just borrowing for trade, but borrowing for growth itself. Money is created through lending. Wealth is measured in future income. The economy starts living ahead of itself, pulling tomorrow's value into today's decisions. It feels like progress. It feels like freedom. But it also creates a new kind of vulnerability. Because when finance stops being about gold, it starts being about belief. And belief can be fragile. At first, the system looks stable. It's working. It's growing. It's making life easier. But underneath the success, a question begins to form. What happens when the belief breaks? That question is where the story truly begins. Because once belief replaces gold, the rules change. Gold does not care about optimism. It does not care about politics. It does not care about confidence. But a credit-based system cares about all of it. London became one of the places where this new reality was tested in real time. Banks learned that they didn't need to keep every coin for every promise. They only needed enough to satisfy withdrawals. On a normal day, the rest could be lent out, invested, multiplied. The system could grow beyond the physical limits of metal. And at first, it felt like a miracle. Money became more flexible. Businesses expanded faster. Trade accelerated. New industries appeared. London's markets grew deeper and more sophisticated because they were no longer restricted by how much gold sat in a vault. But then the hidden cost began to surface, because flexibility is another word for exposure. A gold system has a ceiling. It forces restraint. A credit system has no obvious ceiling, which means it can keep expanding until something snaps. And when something snaps, it doesn't just affect one bank. It affects confidence everywhere. This is where the second beat of the reveal takes shape. Banks become creators of money, not in the sense of printing it, but in the sense of conjuring it through lending. A loan becomes a deposit. A deposit becomes spending power. Spending power becomes growth. And growth becomes a justification for even more lending. The loop feeds itself. London thrives in this loop because it knows how to organize it. It builds rules around it. It creates markets to trade the risk. It develops instruments to hedge uncertainty. It becomes a place where the world can borrow, invest, and expand without waiting for gold to catch up. But then comes the third beat. The distance between reality and finance grows wider. The real economy is made of goods, labor, energy, time. But finance begins to float above it, measuring value through expectations instead of substance. A company can be worth billions before it proves anything. A government can survive on borrowing for decades. A market can rise on optimism alone, and optimism becomes a fuel. But optimism is unstable. That's the early conflict forming. Because the day finance stopped being about gold, it also stopped having a hard boundary. It stopped having a natural break. The system could keep expanding, and the only thing holding it together was belief. Belief that banks would remain solvent. Belief that governments would pay. Belief that tomorrow would be bigger than today. London became a master of managing that belief. It learned how to package confidence into products, how to sell certainty in uncertain times, how to turn fear into pricing. And that is where the danger begins. Because when finance is built on belief, the most powerful institutions are the ones that can shape belief, not with speeches, with numbers, with rates, with liquidity, with access. Gold once forced the world to respect limits. Now the limits were psychological, and psychology can break. And when psychology breaks, it doesn't crack politely, it shatters. This is a part of the story where the conflict becomes unavoidable, because the gold system didn't just disappear. It was replaced by something far more volatile. A financial world built on trust, leverage, and the constant assumption that confidence would always return. London became one of the great laboratories for that assumption, because London's institutions learned how to expand credit while keeping the surface calm. They built reputations that made their promises feel solid. They developed markets that made risks seem measurable. They created structures that turned uncertainty into something tradable, something manageable, something that looked almost scientific. But beneath the surface, the system was always fragile. Because a credit-based world is like a tall building supported by invisible pillars. As long as nobody questions the pillars, the building stands. People work inside it, live inside it, build their futures inside it. And then one day, something changes. A rumor, a shock, a sudden loss of trust, and the building starts to sway. The problem is not that credit exists. Credit is useful. It fuels growth. It creates opportunity. It funds innovation. But credit also creates a dangerous illusion. The illusion that value is limitless, that money can be created forever, that the future will always be able to pay for the present. London helped make that illusion feel normal. It built a culture where leverage was not shameful. It was strategic, where borrowing was not weakness. It was intelligence, where risk was not avoided. It was priced, traded, and redistributed until it looked like someone else's responsibility. And that redistribution is where the system becomes seductive, because when risk can be sold, people stop fearing it. They start chasing it. The financial world begins to reward those who move fastest, those who take the most exposure, those who know how to turn uncertainty into profit. And slowly, the system drifts away from stability and toward momentum, not because anyone wants collapse, but because everyone wants growth. That is the heart of the conflict. The gold system forces restraint. The credit system rewards expansion. And when expansion becomes a default, stopping becomes painful. So the machine keeps going. Banks lend, markets rise, debt grows, confidence holds, until the pressure becomes too high. And then you reach the emotional peak of this part of the story. The realization that gold wasn't just a metal, it was a discipline. It was a limit the world could not ignore. Once finance stopped being about gold, the world gained speed and flexibility. But it also lost something crucial, a clear boundary between what exists and what is promised. And in a world of promises, the most dangerous moment is the moment people stop believing. Because when belief collapses, it doesn't just destroy banks. It destroys futures. It destroys jobs. It destroys savings. It destroys stability. And London, sitting at the center of global finance, becomes one of the places where those shocks are felt first. Not because London caused them, but because London's machine amplifies them. It concentrates them. It redistributes them. It makes them global. The day finance stopped being about gold, the world entered a new era, an era where money could expand without limits, and where the only thing keeping the system alive was faith. That's the climax. The moment you understand that gold wasn't the real foundation, trust was. Gold only worked because people believed it meant something. And when the world moved beyond gold, it didn't escape belief. It became trapped inside it. A modern financial system built on confidence, enforced by institutions, and powered by the assumption that tomorrow will always arrive on schedule. London helped build that world. It became a place where credit could expand safely until it wasn't safe anymore, where money could be created through lending until the weight of promises became too heavy, where risk could be priced, packaged, and traded until it stopped looking like risk at all. And here's the sharp truth. When finance stops being about gold, it starts being about control. Control over liquidity, control over interest rates, control over who gets access to capital and who gets denied. The world no longer measures strength in metal reserves. It measures strength in credibility, in market trust, in the belief that a nation, a bank, or a company will survive the next shock. So the resolution is not nostalgia. We don't need to return to gold to understand the lesson. We need to recognize what replaced it. A system where money is flexible, powerful, and fast. A system where wealth can be built quickly. A system where collapse can spread just as quickly. And today, that lesson matters more than ever. Because we live in a time of digital money, instant payments, and global markets that react in seconds. The speed is thrilling, but it's also unforgiving. When belief is strong, the system feels unstoppable. When belief weakens, the system feels like it's made of glass. What happened when finance stopped being about gold is an ancient history. It's the blueprint of our modern world. And the next time you hear about market panic, a banking crisis, or a sudden shift in rates, you'll know what's really happening. Not metal moving, belief shifting. The day